Cargo ships are sitting idle. Ports from Shanghai to California are gridlocked. Amazon is canceling shipments even mid-transit. And China? It's saying nothing, just quietly pulling the levers. What's happening isn't just a supply hiccup, it's a strategic disruption of America's trade flow. And it hits hardest where it always does: your wallet, your loan rates, and nearly every corner of the U.S. economy. On April 3, 2025, China issued a discreet directive to its state-owned airlines. Halt all new Boeing aircraft deliveries. No timeline, no explanation. There was no press release, no media frenzy, just a quiet freeze. Within 48 hours, Boeing's market value dropped by $28.4 billion. Bloomberg reported that the order froze delivery of 84 aircraft, including major models like the 737 and the 787 Dreamliner. Orders Boeing had been banking on to bounce back from its pandemic-era backlog. But quality wasn't the issue. According to a leaked document from China's Ministry of Commerce obtained by the South China Morning Post, this move was a direct response to rising U.S. tariffs. Once a giant symbol of American export strength, Boeing is now facing its steepest international decline in 2 decades.
This isn't just about trade, said CSIS expert Scott Kennedy. It's targeted pressure on a U.S. industrial icon.
At the same time, Airbus stock shot up 11.2% in Frankfurt, as Chinese airlines pivoted to the European rival. Why go after Boeing first? Because in global economic standoffs, symbols matter. Boeing is American industrial muscle. And China didn't shout its warning. It whispered, "Keep raising tariffs, and we'll quietly squeeze your pressure points." But planes were just the beginning. On April 1st, the Trump administration slapped a 145% tariff on over $30 billion worth of Chinese goods. The Wall Street Journal compared it to swinging a wrecking ball through U.S. trade policy. By April 4th, marine tracking data revealed a 47% week-over-week drop in Chinese shipments to the U.S. Shanghai's major port, had more than 71,000 containers stalled, some sitting for over 10 days. The cargo logjam extended to Ningbo and Shenzhen. On the U.S. West Coast, ports buckled under the strain. The Port of Los Angeles saw ship congestion spike to pandemic-era levels. 27 ships anchored offshore, with average delays stretching past 96 hours. The cost to ship a 40-foot container from China to Long Beach skyrocketed from $1,950 to $6,820 in just 10 days, a 250% jump, according to the Freightos Baltic Index. But this wasn't just a logistical bottleneck. It was a chain reaction. Chinese freight firms began pulling out of contracts mid-negotiation, blaming tariff volatility.
"You can't price a shipment when the rules change mid-voyage," said Zheng Qing, director at Sotrans Logistics.
In trying to squeeze Beijing, the U.S. had strangled its own supply lines. And when cargo stalls, it's not just store shelves that take the hit. By April 6th, China's 5 biggest freight carriers, including ZTO and COSCO, halted most U.S.-bound bookings, citing legal risks from retroactive tariffs. The numbers paint the full picture. Exporters faced a brutal choice: ship under risky terms or eat massive losses. In Dongguan, a city responsible for nearly 8% of China's electronics exports, more than 1,200 small factories had gone idle by April 10th. The China Federation of Logistics and Purchasing reported on one supplier making power banks for Five Below and Target. The goods were packed, labeled, and ready. But the shipping company walked away.
"We don't even know if they'll move this month," they told Kakshin Global.
This gridlock isn't theoretical. U.S. Customs data showed a 34% drop in Chinese imports in the first half of April compared to March. Store shelves may still look normal, but the gap is forming, and it's growing. And it's not just cheap gadgets disappearing. Major retailers are taking hits too. On April 7th, internal Amazon memos instructed sellers to halt all incoming China shipments until tariff reviews were complete. Just 36 hours later, Five Below canceled more than $67 million worth of inbound product, about 11% of its Q2 inventory per second filings.
CEO Joel Anderson explained during the April 9th earnings call, "We can't justify paying triple the shipping cost on products that already have tight margins."
This isn't just a budget issue, it's panic. Companies that rely on cheap, fast-moving inventory are getting squeezed. Canceling shipments mid-route is expensive. But trying to sell overpriced goods to price-sensitive customers? That's even riskier. It chips away at something more valuable: consumer trust. And it's hitting at the worst possible moment. U.S. consumer confidence dropped to 75.1 in April, the lowest since mid-2022, per the University of Michigan Index. With back-to-school shipments frozen and summer inventory stuck, retailers are shifting focus to domestic sources. But how long before that strategy leads to bankruptcies? The alarm is now sounding across U.S. manufacturing. On April 11th, Ford paused production of its flagship F-150 Lightning at its Wayne, Michigan plant, missing key microcontrollers from Shenzhen. GM's battery module production in Spring Hill, Tennessee, slowed 60% due to missing capacitors and inverters. According to Autocast Solutions, in just 1 week of April, the U.S. lost production of nearly 41,000 vehicles, costing an estimated $1.66 billion in delayed revenue. At the same time, Stellantis warned that supply issues tied to tariffs could continue disrupting output well into June. The auto sector runs on tight schedules, measured in hours, not days. And when a single part doesn't arrive, up to 2,000 workers can be sent home.
You can't run a modern assembly line without a $12 chip, said Kristen Zichek from the Center for Automotive Research.
Even now, the average U.S.-made vehicle still relies on over 24 parts sourced from China, despite years of diversification efforts. With delays mounting daily, some American factories have begun salvaging parts from other vehicles, a move not seen since the early pandemic-era shutdowns. But this isn't a public health emergency. It's a geopolitical chess match. And if the White House can't bring stability to imports, this vehicle shortage might not be temporary. It could become the new normal. Between April 1st and April 14th, the cost of shipping a 40-foot container from China to the U.S. jumped from $2,000 to more than $7,300. That 265% surge, tracked by the Freightos Baltic Index, is now pushing up prices throughout the auto supply chain. Stellantis, which sources over 23% of its EV parts from China, raised dealer prices on plug-in hybrids by 6.8% to 8% in just 1 week, citing uncontrollable shipping volatility. The Ford Mustang Mach-E saw its MSRP climb by $1,200 after renegotiating freight deals mid-shipment. Even the used car market is under strain. Cox Automotive reported that wholesale vehicle prices rose 4.1% in mid-April, the steepest weekly increase since the 2021 chip crisis. But this isn't just inflation, it's the result of supply chain disruption morphing into pricing chaos. Here's the hard truth. U.S. car dealerships are now shrinking inventory by up to 30% to avoid spiraling costs. A CNBC dealer survey from April 17th revealed what many fear. If you thought the pandemic caused sticker shock, brace yourself. That's the deeper question. Can these prices come back down? Or is this just the new cost of doing business in a fractured global trade system? Shifting operations from China to friendlier countries might sound good in theory, but the real-world logistics tell another story. In Vietnam, port capacity at Haiphong and Cat Lai reached 94% by April 12th, causing shipment delays of up to 6 days, according to Panga. India's freight sector, while expanding, still leans heavily on road transport, over 60% of domestic goods, which doubles delivery times compared to China's efficient rail networks. Meanwhile, Mexico faces its own gridlock. At the Laredo border crossing, truck wait times jumped from 4.2 to 12.5 hours in April, according to CBP data. Take Tesla. After shifting battery module production to Nuevo Leon in 2024, the company is now quietly leasing backup warehouse space in Arizona to buffer growing delays. Apple isn't immune either. Its production shift to Tamil Nadu is struggling, with internal audits showing a 14% higher defect rate from new suppliers compared to Shenzhen. Yes, production is moving, but it's anything but seamless. These partners aren't filling China's shoes, they're exposing new weaknesses. And that brings us to a more unsettling reality. This isn't a replacement, it's fragmentation. On April 12th, China restricted exports of dysprosium and terbium, rare earth metals vital for EV motors and military guidance systems. The move came just 11 days after the U.S. announced a 145% tariff. Atomos Intelligence reports the U.S. gets 78% of its rare earth supply from China. The impact was immediate. Lockheed Martin warned that missile system delivery times could increase from 14 to over 22 weeks. Ford delayed production of its E-Transit and F-150 Lightning due to sudden shortages in high-strength magnets. Defense One revealed that Raytheon is now urging the Pentagon to fast-track sourcing from Australia and Canada. But even under the best-case scenario, those sources won't ramp up until late 2026. This wasn't a full ban. It was a calculated strike. It hit industries too important to pause, but too slow to pivot. And in a rare moment of candor, GM's EVP Doug Parks told Bloomberg on April 15th, "There's no replacement that's fast or cheap enough to make up for what we've lost." This was never about a full cutoff. It was pressure, delivered precisely where it hurts most. Is U.S. car production bouncing back, or just rerouting? Tesla is accelerating plans to assemble the Model 3 in Berlin by Q3, bypassing U.S.-bound parts altogether. Toyota is redesigning its 2026 hybrid lineup with simpler drivetrains to cut chip use by 30%, according to Nikkei Asia. Stellantis is mapping an all-Mexico manufacturing run for select U.S. models, at least until trade tensions cool. But none of this is cheap. New factory lines, new labor contracts, new logistics deals, all of it adds 4 to 6 months to launch timelines. For consumers, this means longer waits, fewer incentives, and more stripped-down cars. J.D. Power's April report showed average new car prices in the U.S. rose to $47,770, a $2,600 spike in just 30 days. For automakers, this may now be the only realistic path forward. If China is no longer reliable and its replacements can't scale fast enough, then the global auto industry isn't relocating. It's splintering. But the deeper story isn't about supply chains. It's about the road ahead. This isn't a trade hiccup. It's the deliberate dismantling of globalization's most efficient artery. But if you think the US-China shipping freeze is the final act, think again. A much bigger shift is looming, not at docks or factories, but in finance. Foreign ownership of U.S. Treasury bonds just hit its lowest level since 2011. China isn't just cutting off goods, it's quietly shedding American debt. And if Beijing ever takes direct aim at the U.S. dollar, that will be the next battleground. We're about to step into it. Stay tuned for more breaking updates. Catch you in the next one.